Everyone's asking, is it finally safe to invest in China again? The media says it's too risky, but billionaires like Ray Dalio and major firms like BlackRock are quietly making calculated moves. In this video, I'll break down the real risks, the hidden opportunities, and why ignoring China could be just as dangerous as investing blindly. Stick with me until the end, because I'll reveal the specific sectors where the smart money is positioning right now. I'm Robert, and welcome back to The Alternative Investor. Let's be real, investor hesitation toward China isn't baseless. Over the past few years, the Chinese government has cracked down on its own tech giants, including companies like Alibaba and Tencent, creating massive uncertainty for both domestic and international shareholders. Government regulation has become more aggressive across a wide range of private industries, from education to gaming to e-commerce, signaling a shift in how corporate power is handled in the country. China has also been battling a major economic slowdown, largely triggered by the collapse of its real estate sector, with massive debt loads and unfinished developments causing ripple effects across its economy. On top of that, geopolitical tension with the United States remains high, with tariffs still in place, technology export bans tightening, and ongoing disputes over national security, trade policy, and intellectual property rights. All of this combines into a clear narrative that investing in China is dangerous, and at face value, it's a compelling story. But what if it's only half the picture? We'll come back to that shortly, because something big is happening beneath the surface. While retail investors have pulled back, major institutions are starting to re-enter China, slowly and strategically. Ray Dalio's firm, Bridgewater Associates, has increased its exposure to Chinese markets, citing long-term structural opportunity despite near-term volatility. BlackRock, the world's largest asset manager, recently launched new China-focused funds, aiming to capture value in sectors that are aligned with Beijing's growth agenda. Goldman Sachs analysts have also upgraded their outlook on Chinese equities, recommending long positions in companies like Alibaba, JD.com, and other internet and e-commerce names that were once seen as untouchable. Why are these moves happening now? Because history shows that when fear is high and sentiment is low, that's often when the best opportunities emerge. In response to economic pressures, the Chinese government has started stimulating growth by cutting interest rates and easing credit restrictions, giving the economy a much-needed push. They've also made a clear pivot toward future-focused sectors, including artificial intelligence, renewable energy, and advanced manufacturing, and are pumping billions into these areas. At the same time, they are opening parts of their economy to foreign investment in ways that were previously restricted, such as allowing more foreign participation in financial services and advanced tech manufacturing. We'll return to this point later when we talk about how and where to actually invest within China. Despite the broader economic challenges, not every part of China's economy is in decline. In fact, several sectors are growing rapidly. The green energy and electric vehicle sector is booming. Companies like BYD and CATL are not just dominating in China, they're becoming global players, exporting EVs and battery technology to Europe and beyond. The artificial intelligence space is expanding quickly, fueled by government subsidies, public-private partnerships, and intense national focus on becoming a global tech leader. Luxury goods consumption is also rising, particularly among China's expanding middle and upper middle class, who continue to spend heavily on premium domestic and international brands. China's healthcare and biotech industries are growing as well, driven by an aging population and increasing demand for high-quality medical care and pharmaceuticals. So while legacy sectors like real estate and traditional finance continue to struggle, these future-forward industries are gaining momentum, and they're shaping the next phase of China's economic story. Of course, we can't talk about investing in China without addressing the elephant in the room: political risk. The Chinese government has shown it's willing to step in and regulate companies aggressively, restructure industries overnight, or impose rules that may seem unpredictable to Western investors. Unlike democratic systems where policy changes tend to move slowly, China's centralized government can implement sweeping changes quickly, which creates both opportunity and risk. But here's the nuance. Most of the heavy-handed interventions we've seen have been concentrated in a few sectors, especially consumer internet, private education, and online gaming, areas where the government believes companies were gaining too much power or influencing public culture. In contrast, sectors that align with the state's strategic goals, like semiconductors, green tech, and biotech, are being actively supported with grants, favorable policies, and institutional capital. So while the political risk is real, it's not uniformly distributed. Later, I'll show you how to invest in a way that minimizes that exposure while still capturing the upside. So let's bring it all together. Should you invest in China now? If you're using broad China ETFs like FX1, you're getting exposure to a mix of outdated financial firms, state-owned enterprises, and real estate-heavy plays that may never fully recover. Instead, targeting sector-specific exposure, such as renewable energy, electric vehicles, AI infrastructure, and health tech, gives you a more focused way to capture growth potential while avoiding deadweight sectors. If you want to reduce your risk while maintaining international exposure, you could look at emerging markets ETFs like IEMG or VWO, which include China but with a lower percentage, giving you more balance. You can also consider investing in multinational companies that benefit from China's internal demand without being based there. For example, LVMH benefits from luxury demand, and Novo Nordisk benefits from healthcare expansion, both of which are fueled by Chinese consumer trends. The bottom line is this: the opportunity is real, but you have to be selective. Here's the real answer. Avoiding China altogether could mean missing one of the most significant structural shifts in the global economy, a shift that's already underway. But investing without understanding the political environment, the sector-level risks, and the market's transformation would be just as reckless. So should you invest in China now? Yes, if you're strategic, informed, and focused on where the opportunity truly is. It's not about betting on a country, it's about understanding a trend. And right now, China is trending in a direction smart investors won't ignore. If you want more content that cuts through the noise and gets to the real investing trends that matter, hit that like button, subscribe to The Alternative Investor, and let me know in the comments. Are you ready to invest in China, or are you staying on the side?